Hello and welcome to Donut Investment. This analysis is for Netflix on NASDAQ as of 4th of August 2026 with a share price of $73.03. The full report is on donutien.ca. A world-class streaming franchise, quality still 78, but after stripping a one-off FX gain, the clean price earnings is about 27 times, past the sector rich line, so valuation re-rates to expensive. All three horizons step to hold, with medium and long downgraded from buy this run. A don't chase on price, not a deterioration. Start with what hasn't changed. Netflix is the world's largest paid streaming service, well over 300 million memberships across roughly 190 countries, the biggest content budget in the business, and a recommendation engine few rivals match. The model has flipped from cash burn to cash machine. Trailing revenue near $48 billion, compounding about 13%, operating margins around 30%, and free cash flow near $12 billion. That earns a business quality score of 78. The moat is real, but not impregnable. Netflix is losing share of total television watch time to YouTube, and the rival set is consolidating. So we score switching costs and cost advantage honestly. Here is why the call changed. The headlines say Netflix is cheap, a 4-year low reported price earnings near 23 times after a 40% drop from its peak. Two adjustments flip that. First, clean earnings. First quarter net income carried a $2.1 billion non-operating currency gain, about 16% of trailing profit. Strip it, and the clean price earnings is about 27 times, not 23. Second, the rate anchor. With the 10-year yield at 4.75%, we can warrant only about 24 times. Clean 27 sits above the 26 times communication services guardrail, which places it in the expensive band and trips the valuation ceiling, and under the framework that sector line is supreme, no growth story overrides it. So the signal caps at hold, and valuation drops to 38. The final piece is timing and the macro. The tape is a downtrend with a shallow bounce. After July's post-earnings gap to a 52-week low of $65, the stock has recovered to about 73, but still trades below its 50-day near 77 and well below its 200-day near 91, with relative strength deeply negative. That reads neutral, not a confirmed reversal. The technical entry group is unmet. On top of that, the macro sector map flipped communication services to underperform, so economic alignment is now a contrarian headwind rather than the tailwind of the prior report. Analysts are still constructive, a $92 consensus, about 26% above spot. But under our clean earnings, rate-adjusted read that upside is not on offer at a fair price today. We weight the risks at least as loudly as the positives, in both directions, because this is a hold. On the downside, the bear case is $58, roughly 20% below today. It fires if YouTube's watch time lead widens, the advertising ramp disappoints, and a cooling consumer pressures net ads while the sector derates. The stop sits at $62, below the $65 low. But the don't chase cuts the other way too. If you sell here, you give up the bull case at 96 and the 26% to the analyst consensus on a genuinely elite franchise. The point of a hold is that neither the reward for buying at a full multiple nor the case for selling a great business is compelling at $73. Now weigh the risk against the reward. The bull case is roughly 31% above today, the base case, the most likely, about 11%, and the bear case a fall of about 21%, so you are risking about 21 to make 31. So our call on Netflix on NASDAQ. Hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donut Investment at donutien.ca. The link to the full report is in the notes below. Have a great day.